When a commercial jet engine shuts down for maintenance, the airline loses potential revenue for every day that plane sits idle on the tarmac. This is the hardware at the center of FTAI Aviation. They specialize in the CFM56 and V2500 engines that power much of the global 737 and A320 fleets, framing their role not just as mechanics, but as disruptors in how these assets are managed. The standard approach to engine repair is an overhaul. An airline sends the engine to a shop, waits months for it to be rebuilt, and absorbs the unpredictable costs and capital drain while their asset is out of commission. FTAI's alternative is a proprietary model they call Maintenance, Repair, and Exchange, or MRE. As this timeline shows, instead of waiting for a rebuild, an airline can bring a run-out engine to FTAI and swap it instantly for a fully maintained replacement at a fixed price. Providing that operational certainty has allowed FTAI to secure a 10% market share in the aftermarket for these specific engine types. Management has now set an aggressive corporate target, expanding that footprint to capture 25% or more of this specific market. By absorbing the downtime risk for airlines, FTAI has built a specialized position in the narrow-body engine market, connecting maintenance capabilities directly to the financial performance of its customers. This maintenance labor provides the cash-generating foundation for a much larger financial structure. That brings us to the second division of their business model, strategic capital. Strategic capital raises billions from institutional investors. In May 2026, the company successfully priced an inaugural $612 million asset-backed securitization, supported by strong investor demand. This capital is used to buy commercial aircraft, which are then leased out to global airlines. This creates a direct synergy. Many of these leased planes are contractually obligated to use FTAI's MRE division for their engine maintenance. The scale of this captive ecosystem currently includes 292 owned planes leased to 23 different airlines. This creates a self-feeding loop. Investor capital buys the aircraft. Those aircraft provide a steady stream of maintenance work, and that maintenance generates more capital. FTAI is now applying this logic to a third division, FTAI Power, which pivots away from aviation and into the data center energy market. When aviation engines reach the end of their flight life, they are converted into aeroderivative gas turbines. Through a partnership with the Jereh Group, the company intends to manufacture and deliver these mobile-mounted power units in under 2 weeks. The production goal is to have 100 of these power units deployed by 2027. By extracting a second life from depreciated flight hardware, FTAI positions its power division to meet the increasing energy demands of the data center market. In the fourth quarter of 2025, revenue reached $563 million, driving 76% year-over-year earnings growth. This translated to $158 million in adjusted free cash flow during Q1 2026, pacing toward a $1.2 billion target for the full year. These compounding metrics suggest that FTAI is operating as an efficient cash-generating business rather than just an aviation servicer. However, the tension remains between FTAI's expansion plans and the underlying structural risks. The optimistic case is supported by institutional trust, including rating upgrades from Fitch and S&P, and the launch of a second leasing fund. Success in reaching their 2027 power targets would further integrate their maintenance and energy divisions. But the capital and physical inventory required to launch new leasing funds, while simultaneously stockpiling power turbines, is significant. As of the first quarter of 2026, the company's balance sheet showed $3.45 billion in corporate debt. This debt load means that any period of macroeconomic tightening could pose a challenge to the stability of the entire financial flywheel. FTAI is currently at a critical intersection, managing a transition from specialized aviation maintenance into the broader energy sector. The question is whether this synergistic model can sustain growth across these markets, or if structural complexity will strain the balance sheet. Evaluating these balance sheet risks is a necessary step for any observer. This video is strictly for educational purposes and does not constitute financial advice.